Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. Today we return to the oil market, a market that is in flux, both from a traditional supply and demand picture, but now also embroiled in geopolitics, an uncertain global trade environment, and potential recession. Is oil going lower for longer? And what about volatility? The last month or so has seen a dramatic return of volatility and associated results for traders, positive and negative. Is that set to continue? Our guest is Matt Smith, Lead Energy Analyst for the US at the data and analytics company Kepler, giving us very much a global view of what's going on in the oil markets. All being well, this is going out on May 14th, one day before our live podcast event sponsored by ITFA in London, talking about volatility and uncertainty in commodity trading. There might be one or two spaces left at the auditorium. If you have any interest in getting a last-minute ticket, please do email me or reach out on LinkedIn and I'll see what I can do. As always, you can really support the show by sharing the episodes with your colleagues and liking it and indeed giving us a written review on Apple Podcasts or wherever you might listen. And as always, I hope you enjoyed the episode. Matt, welcome to the show.
Thanks for having me, Paul.
So we're recording this on May 8th with the expectation that this goes out next May 14th. And normally we have a longer lead time between podcasts, but we both decided that things are moving so rapidly in the oil market, no one's going to listen to something that's so out of date or even a couple of weeks out of date. So that's the plan. So if stuff's kicked off in the interim, you'll have to, in the 4 days in between, you'll have to have our apologies. But we are talking indeed about the oil market, kind of where it's been over the last few months, what the outlook is for 2025 and beyond, and trying to piece together lots of moving pieces that have meant that oil's dipped to its lowest since sort of mid the last decade in the wake of sort of shale going full force and indeed obviously COVID as well. But it's a significant moment and there's lots of moving pieces, both not just typical market supply and demand, but also a lot of exogenous factors from politics and so forth coming in. So you've got your work cut out. But let's start at the very big picture on supply, because there has been some shifts over the last few years, stuff coming online from Latin America, etc. Can you just set that up, the big supply picture for us?
Yeah, absolutely. And I think just the fact that OPEC has been keeping barrels off the market for the last few years here is just a reflection of how much non-OPEC supply has been hitting the market. So from a demand perspective, we continue to add barrels year after year after year, right? So the demand growth continues. And so we still need more supply, but it's really been coming through from the non-OPEC side of things. So particularly with the US, we've seen a lot of strength from the shale side of the picture in recent years. But then you've also had other additions which incrementally have added up to a large volume. So we've had production growth out of Canada, out of Brazil, out of Guyana, Norway. And so you put all these together and add that with the US, and you've got really this wave of supply that has been essentially overwhelming the demand side of the picture. And you've had OPEC having to keep barrels in check to make sure that the market prices are holding up here.
Yeah, absolutely. And just to be specific about that, can you because at the same time we're seeing increases in production, you mentioned Canada, but also places like Guyana, Argentina, we're also seeing that in some part being offset by sort of what looks quite a terminal decline in Mexico production. Can you just get a bit more granular on that for us?
Yeah, sure. So with Latin America, as you mentioned there, you've got Vaca Muerta is the shale play that is just being developed in Argentina. But
Dead cow.
Exactly. Yeah, exactly. But that's not a huge amount. You've had other ones. Guyana has been the real huge success story of this decade in that it wasn't producing anything last decade. And then there's been all these oil discoveries there. And you see these crude streams sequentially coming to market. So we had the first one coming online in 2020. Then we had the second one follow, sort of 2021. Third one has hit the market. We've got the fourth one coming in the coming months here. So incrementally, you're adding sort of 250,000 barrels per day. We saw exports out of them hitting 750,000 barrels a day last month. You add this new crude stream, Yellowtail, and suddenly you're getting a well above 900,000 barrels per day. You've essentially got a Libya coming to market here that just didn't exist, half a decade ago. So Guyana has been increasing. Brazil as well. Brazil, continues to break our hearts. Us analysts are predicting production growth out of them. They were expected to grow the most last year, and they ended up dropping year on year. But this year, we've got 4 months under our belts. Their production is increasing. We're seeing that showing up in larger loadings out of them. And then they have 3 more FPSOs that are coming online in Q3 of this year. And so that's going to really kind of be ramping up production. So those are kind of a couple of the key success stories. Argentina is still yet to come through, growth of about 70,000 barrels a day this year on year. So a bit, but nothing like as strong as we've seen from the likes of Guyana. Now, countering that, as you mentioned, you've got Mexico, where we're seeing production continuing to drop from them. And that's the key bit for the US as well, is that it's the exports that are dropping. So we have seen that their refinery runs have been improving in recent years, but it's also been just the lack of investment and these older aging fields, which have caused their production to drop from 1.9 million barrels a day in kind of late 2023 down to 1.6-ish now. So a kind of real kind of constraint there. Hugely problematic for the US Gulf Coast, because US Gulf Coast imports about 1.1 million barrels a day. Traditionally, Mexico has accounted for about a half of that, and we've seen that piece of the pie gradually dropping 2023, 2024, and so far this year as well. So it's not all success stories coming through from Latin America. And then just the final one, Paul, is just with Venezuela. So Venezuelan production has been in, structural decline for a good number of years here. Back late last decade, they were still producing over 2 million barrels per day. Now they're down below 1 million barrels per day. They had Chevron that was operating there, that was granted this joint license, which meant we saw a gradual increase in recent years because of that. And now the kibosh has essentially been put on that. That Chevron license has been revoked. We're having to see them winding down operations there, which is meaning we're expecting production to drop even further now, just kind of rolling over again. And again, this is to the detriment of the US. We saw about 300,000 barrels a day, as much as that, coming into the US from Venezuela because of this joint venture, and that is stopping.
And that's the problem, right? Because, and we'll come back to this in a little bit, but of course, all the US refineries are, for the most part, set up for heavy crudes. And those have traditionally, those have come from Venezuela and Mexico. And so that is going to cause a headache, right? I mean, we'll come back to it, but just to put a pin in that.
Yeah, exactly. So the US Gulf Coast accounts for like 45% of total US refining capacity. It's on the water there. It's there because traditionally you've seen cargoes coming in to be discharged, and that's coming from Latin America, which is all kind of, for the most part, heavy sour crude.
And then shout out to my wife and her team, who have spent a lot of time in Guyana these last 4 years. So,
Wow.
we've which sounds like a fascinating place, but is as you say, is a great success story, and exciting what's going on there. But okay, so thanks for that sort of, I guess, the Americas piece. I mean, you mentioned it there, right? So all this new production has come online. It's been offset in part by Venezuela and Mexico declines, and Brazil in some part not sort of really meeting expectations. We're going to come on to tariffs and sanctions in a moment, but obviously the big story at the moment, not to bury the lead, is that OPEC are have been suffering the brunt of this and have been the ones making room for it, and that appears to be changing. That can you take us back to sort of the fall last year when sort of they started to announce that they were going to increase production, and help us unpick the why behind that and the how behind that, if you like?
Yeah, absolutely. So we saw OPEC cutting production a number of years ago. It was like in a series of tranches, essentially. And the third one was one which was voluntary, and it was kind of OPEC 8, a group of 8 members that promised to do these additional cuts. And so fast forward to coming into this year, and the straw that has broken the camel's back has been with Kazakhstan. So Kazakhstan, over the last number of decades, has been trying to get the Kashagan field up and running, the Tengiz field ramping up. They've been, and it's not just the national oil company there; it's international oil companies have been investing for decades to get this production to market. This production ramps up, and this is at a point where they're supposed to be cutting over the last few years. And so it's become more and more of a contentious issue, particularly at the beginning of this year, when you've essentially got Kazakh production is supposed to be below 1.5 million barrels a day crude only. And it's been more than 300,000 barrels a day higher than that. And the challenging thing for the national oil company there is that it has to go to the likes of Chevron, Eni, that are operating there, that have invested over these decades, and ask them to cut production when they've just managed to ramp up. And so this essentially has caused a lot of frustration within OPEC. One thing I will say, two things. One is that Kepler has been named as a secondary source for OPEC. That happened in early February. So we are information sharing, and so we do have access to delegates and that. So we're getting, I'm just not pontificating here or speculating. It's more kind of based on our conversations that we get to have. We also have Amena Baka that joined us in early February, coincidentally at the same time. So she's very close to OPEC members, has a lot of discussions happening there. So, there are these fractures that have essentially got so wide there because of the frustrations with Kazakhstan, traditionally with Iraq and Russia as well, who have tended to overproduce. So you've got a situation where you have like a core OPEC, which is kind of a Saudi, a Kuwait, UAE, and UAE has invested billions over the last few years here to ramp up its production capacity. And they've done that, but they're still being kept in check. So UAE produces about 3 million barrels per day. They have production capacity of 4.8, 4.9. And so they're chomping at the bit to be able to put barrels onto the market, but they're behaving themselves, and Saudi is, etc., whereas some members are not. And so that's what has caused this immediate kind of fracture there.
Is this in any way existential for OPEC?
Mm-hmm.
Because you've got members there who might have been important in 1970, but no longer really are,
mm-hmm.
right? I'm going to argue different cases, right? And you've got these, basically that alliance of Kuwait, UAE, and Saudi that really are the main players. And you've, as you've highlighted, you're starting to see fracturing of incentives throughout the group, and there is a chance that in the attempt to keep everyone in line, OPEC breaks itself,
mm-hmm.
which just from that global supply picture you've just given, and bear with me, I'm a recruiter, so I'm piecing this together. But it would seem that if you without OPEC there, we'd have a very different oil picture entirely, right? We'd have a structural shift lower based on
it'll be a battle to the bottom, basically. Yeah, when you have so much kind of supply that is hitting the market here. But, OPEC has traditionally been that player with the pulleys and levers, and someone like a Saudi Arabia needs a budget of $91, $92 or price of oil to meet their budgets. And a number of the players with OPEC need much higher prices than where they are now. And so that's why they intervene in the market as they do, and why they have done traditionally. And, they still account for such a large piece of the global oil market. They're the only ones that could really kind of not manipulate, but try and control those prices. And so you can understand why they have done it. It's just they get themselves into situations like we're in now, where you're stuck between a rock and a hard place. Do you increase production, try and get back some of your market share, but then it means prices drop? Or do you hold barrels off of the market here to try and support prices? And then you have countries essentially taking and eating your lunch because you're not putting barrels on the market. So it's a tough one for them, isn't it?
Yeah. And the political backdrop to this, though, is that they do have some cover here to lower prices, right? It would seem that you've got, obviously, the Trump administration very publicly talking about low energy prices. even though that we've discussed in this podcast, that is somewhat mutually exclusive to the idea of energy dominance in the US, if, unless we don't have a free market for oil. So they do have some cover to lower prices. And obviously the market has, again, we're talking on May 8th. We did see a structural shift lower in prices in April as the market anticipated OPEC statements around 400,000 extra barrels a day, all this kind of stuff. So I'm just a long-winded way of saying, of those, that between that rock and a hard place, which one are they tending toward?
Well, what happened back in April, it was the combination of them announcing that they were going to start putting more barrels back onto the market at the same time that we've had so many concerns about tariffs and that impacting not only demand growth, but the economic backdrop as we move along here from a global economic perspective. And so that is the real kind of crux of the situation here, is that from our estimations, demand growth last year was at 1.2 million barrels per day. This year we're revising it down and getting closer to half of that. And so I think that is the expectation, is that you're not going to have demand growth continuing at the strong pace that we have seen it over recent history. And this is at a time when OPEC has to make these hard decisions about, if they, like a UAE, who has so much spare capacity just sat on the sidelines, let alone the same for Saudi, that are just chomping at the bit, worrying as they look at these demand growth numbers and thinking, are we going to be seeing oil demand plateauing as we move into next decade? How does this evolve for us that have large budgets that need meeting when oil prices are at half the price they need to be?
Yeah, you don't want to be there in 15 years with great reserves and actually things have moved much more rapidly than you expected. But you're also alluding to there as well, right? Obviously, at the beginning of this year, there was that expected growth because, economies were growing robustly and, there's a lot of optimism out there. That's changed and now everyone is pricing in a recession, which again is kind of the other arm to actually, if you were to lower prices through increasing production, you could do it under the rationale of supporting challenged economies around the world, right?
Yeah, and that's when you come back to the US and the challenge that is being faced in the US administration is targeting low prices at the pump, which makes total sense, right? In that over the last few years, the top 10%, top 5% have made out like bandits, right? Because they've been invested in stock markets, their assets have continued to increase, whereas your everyday person that is out driving along the street and sees that gas station every few minutes with the price there, prices have been holding up really rather well. So by lowering that price at the pump is giving money back into the pocketbooks of the everyday man. So from that perspective, it makes sense why they're targeting that lower price at the pump. The only challenge is that's very much juxtaposed versus drill baby drill, right? Because you can't have both of those things. And so I think what we're getting that's going to play out in the next few months, if we do see prices continuing to hold below $60 on WTI, is that you will start to see US production growth turning negative. Yes, the silver lining for that is we're going to have those lower prices at the pump, but that's kind of the decision you have to make there. And I think when it comes to OPEC, it's the same challenge, right? In terms of like how many barrels do they push out and versus the price versus being constrained and getting that higher price. It hasn't worked out well for them, right? They've from both kind of aspects in that they've tried to squeeze out shale sort of mid last decade, and we did see prices absolutely crater. We saw the price war in April 2020. Granted, that was a terrible timing to do that right at the beginning of COVID, but it just didn't work, right?
Yeah, it's certainly tough. Right, let's just talk, before we sort of dig into what could break this sort of picture of, of lots of supply, demand now not only under threat from sort of a 20-year horizon, whatever that horizon might end up being, but also certainly in the short term from a recession. Tariffs, we've got sanctions, the oil's still flowing, we've covered that story a lot, but tariffs, there aren't, from a US perspective, and then how that cascades globally, how, if any, are tariffs affecting oil? What's the expectation there?
Yeah.
Obviously, there's a lot to do with the materials that go into producing the oil, even if the oil itself isn't tariffed. And this kind of brings back in that perspective of, hang on a minute, the US's refineries were built at a time when the shale wasn't around.
Right. And so the fortunate thing with the tariff side of things, at least from an immediate US perspective, is that not applying tariffs on Canada or on Mexico, and we never kind of expected them to be put in place on the energy side of things, simply because the US is so reliant upon those two countries, particularly Canada. We're importing well over 4 million barrels per day in terms of crude from Canada, leading source, leading supplier to the US by far. And then even with Mexico, even though it's dropped off, they're kind of still in second place there. So fortunately, from that side of things, those tariffs are not looking a concern. So the US market,
as long as the Canadians don't react, right? I mean, again, it's kind of like this critical minerals piece with China. Actually, to use that terrible phrase, we don't hold the cards on a lot of this stuff, right?
Yeah, but I think it kind of dwarfs it, right? When you look at Canadian production is around 5 million barrels a day, 4 million barrels a day. That is to the US, and it's not like they have another market they can send it to, because there's been the Trans Mountain pipeline expansion, sending those barrels to Vancouver to be exported, but that is only 10% of their total exports. They're still sending well over 3.5 million barrels a day south by pipe, and that can't go anywhere else. So it is that kind of captive market.
No, but if you imagine, if things were to get particularly bad, right? That is a scenario out there that it would be relationships would have gotten truly atrocious for that to happen, as you say.
For sure, there'd be the tit for tat, kind of like we're seeing with China now. It seems that China is probably going to be the one area where those tariffs are going to stick, right? Or where the US government is essentially going after them. Whereas with Canada, with Mexico, it's more been used as a negotiating tactic, right? Something to hold over their heads. But in terms of China, that's the situation where those tariffs are really going to play out, and potentially to the detriment of the US, given how much we're pulling in from China. But from an energy perspective, there, we're fairly. They aren't dependent upon us for crude by any means, and those crude flows have virtually dried up because of the tit for tat tariffs in place. We are LNG has been able to be rerouted. There was only really kind of ethane, which the ethane market, the US is the only exporter on a global basis of ethane. A lot of that goes to China, and so even though there's been all this tit for tat stuff, China's been like, okay, we'll do a waiver for the ethane because there's certain things that still need to flow, and so that's why I'm not concerned about Canada and Mexico, because we need those barrels to flow.
The one thing I hear from conversations, on the upstream side, which we're not, as HC Group, we're not really in, right? We're much more sort of in the midstream, downstream, the commercials piece of it, but we're expecting 20% inflation across the board at the lowest level with regards to all of the materials, the costs of actually producing these crudes, whether that's offshore or even onshore. If the 10% tariffs stick in place and some of the other around aluminum and steel and so forth, I mean, that is you can suddenly see a picture there where prices are in the 50s or even lower, depending on OPEC's continued decision making. And at the same time, costs are through the roof. I mean, that would put a real challenge on shale production. Is that something, how likely is that scenario? Is that something you're hearing? What effect would that have?
I think it's still in the works, right? I think we still need to get greater clarity on that, because we're nowhere near the end game. This is still the negotiating tactics. And as I said, I think China will be the one where the deals are struck last, right? But inevitably there will be some type of deals there, because with prices in the 50s, you're going to be seeing US production growth, rolling over, let alone if you have higher input costs for steel, for pipelines and all that kind of stuff. So that really could be very detrimental. But to some extent, the US government is aware of that too. And so that will all be part of the negotiations, you would like to think.
Yeah, you'd like to think. Although, again, we are hearing, whether it's true or not, but a lot of these oil companies are struggling to get through to the administration on some of this stuff as well, right? It's not quite this is not where the administration is focused. It's focused very much on China as, trade practices, but it's also very much focused on lower energy prices and lower costs, despite the price of dollars going up and all this kind of thing. It doesn't seem to be a key part of the, in some ways, the shale production has now meant this sort of segment is somewhat taken for granted, I would imagine.
Yeah, and to your point with that, even when we were talking about Venezuela earlier, that Venezuelan piece is so integral to US supply on the US Gulf Coast there, and to replace that much volume is going to be challenging. It's going to cause, we're seeing it play out, heavy sour prices rising. And yet you had the drill baby drill meeting where you had a number of these shale company executive CEOs and that go in speaking with Trump, and yet he still revoked the Chevron license. And so it's a little challenging to get your head around what their ultimate goal is with some of these things, and why they don't see some of the consequences that we do, even if they're being told about them.
And again, it comes back to actually that voice isn't as significant as perhaps it was 20 years ago when the US wasn't an exporter of energy. It was an importer.
I don't know, because it's way more important now than it was 20 years ago, because the US is producing 13.5 million barrels per day. US is exporting 4 million, but we're still importing a lot of crude as well, right? 6.5 million barrels a day. So the importance of US energy, not just a crude perspective, but a natural gas perspective, has never been more important from a volume perspective, because we're at record production basically for crude, getting there around it for natural gas, record natural gas export, LNG exports. And so you would think,
but that's making money, right? I mean, you just go back to sort of the wiring of the administration since the 70s oil shock, and you were a big importer of energies, crude in particular, and from a political standpoint, you just cared about prices and inflation. And so there was quite a feedback loop there from American oil companies wanting to be able to participate in global free trade, open up these countries, have incentives and tax breaks to make the investment, arm in arm with the State Department. And I'm just sort of, that is a different scenario today, where we've got loads of, by far and away, what has accelerated the US's growth over Europe, take aside some regulation, all this kind of stuff, has been ultimately shale and the riches that has brought. I'm just sort of saying that it wouldn't seem to be as front and center to in other words, is the Trump administration picking up the phone to the Exxon CEO the same way perhaps the Bush administration did?
Yeah. It's a tough one, because you would think that they would, like to your point, like with Europe versus the US, the US has used natural gas as the bridge to a renewable future, right? Whereas Europe essentially fast forwarded and skipped that piece of it, and it has been very much to their detriment, and that's been shown up because of everything with Russia over the last couple of years. But it is not like the US is more independent from an oil perspective, from a natural gas perspective. Yes, or from a power generation perspective, less reliant on coal, more on natural gas. But from an oil perspective, the US isn't independent. It never will be energy independent. It is still importing 6.5 million barrels a day, because there is that mismatch between light sweet crude that is maximized in refiners. You can't run more light sweet crude through refiners. They need the heavier, the more sour barrel to be able to run, and that's just not available in the US. And so you're kind of at an impasse, right?
Yeah. Well, any answers on a postcard? Any CEOs from large oil companies, and let us know whether you feel, as the prettiest girl at the ball, as you. I can't say that, can I? let us know of how many rings it takes for them to pick up the phone these days compared to in the past. But anyway, right, okay, so. And again, I think all of this just points out the sort of, this really is 4D chess trying to figure all this out, right? And and obviously a challenge. If we move on to kind of the shocks to the shock to the downside, I guess, is that OPEC really does sort of open up the spigots, and for all that incentive, right? You've got inflation, you've got as a result of tariffs, you've got a recession, you've got the desire to control Kazakhstan, and you're finally fed up with Latin America and the US, the independent eating your lunch.
Yeah.
So you could see that, right? And we've obviously seen that before. That's the shock to the downside, I would imagine.
It is, but I don't think that's OPEC's target, right? I think they've learned from historical lessons that's going to end badly. So they're increasing production right now, but it's likely to be a temporary thing. They're doing it to relieve some of the frustration within some of the larger producers that have higher spare capacity. But ultimately, you can't keep adding as much to the market as they're looking to do, month after month after month after month, without, it getting overwhelmed by that. What the interesting dynamics at play come in when you talk about the likes of Iran, right? So US administration comes in, we immediately assumed, first day, second day, you're going to have US administration picking up the phone to the Saudis saying, hey, how you doing? Nice to chat with you again. What do you want? And from that, they say, we want you to go after Iran. So we immediately took out 500,000 barrels a day of Iranian production from our balances coming mid-year. So very, very soon, just on the expectation that you will get maximum pressure from the US administration on them. Now, it doesn't seem as if they want to give that maximum pressure. You do have with Trump for all of his off-the-cuff talking, you can glean certain things. So even when he first started talking about targeting Iran, he said, I don't want to do this, And I think he doesn't, because he knows ultimately if he takes barrels out of the global market, it is one big bucket of supply, which will mean that prices will rise. Prices at the pump will increase. And so our concern going forward here is that, yes, it looks like they could go after Iran, but we may not see 500,000 taken out of the market. We may not see 300,000 barrels a day taken out, which then is an adjustment again to your balances when global balances already look pretty soft going forward here. So
yeah.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global expert network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insight call to a longer-term consulting project at encoinsights.com.
Iran is the reason why we sat down to record this, I think, 3 weeks ago, and decided that we actually, given the podcast schedule, there was no point, because Iran is the big sort of surprise to the upside potentially, right? And it's the big unknown, and actually in a changing and evolving story. So 3 weeks ago, very much that maximalist position, two carrier groups, there. And just before we talk about likelihoods and kind of, because right now we're starting to hear noises of there are discussions going on, there seems to be some progress. As you say, President Trump is kind of on the grand scheme of things historically quite dovish compared to sort of other advisors and so forth. But just playing out the scenario that there is sort of this breakdown of negotiations and some combination of the US, Israel, we develop into a shooting war there, or at least a significant, a kinetic escalation, to use the term, that shuts down the Straits of Hormuz. That has a profound impact on the oil market, even for taking out Iranian oil supply. That suddenly puts a lot of other supply in jeopardy as well. Can you just give us some sense of that?
Yeah, sure. So the two cases really are two, not base cases, but two very different scenarios. Is one, the barrels just keep on flowing, right, out of Iran, which is ultimately to the benefit of China. China is taking basically all of that 1.6, 1.7 million barrels a day of exports. And while there has been intermittent hesitation by the Chinese to bring those barrels on shore, ultimately they're still doing that. So that those barrels continue to flow. If that continues to happen, the balances look really quite soft. The flip side to that is the maximum pressure, and it's really the most bullish argument in the market right now, along with low inventories, is that okay, you see that 1.6, 1.7 million barrels a day taken out of the market, shut in from Iran. If that were to happen, yes, by all means, it would cause prices to really rally. From a simplistic perspective, China would have to be replacing that much back in the market, going to the market and buying that, not at a discount, but at a full price. And so because of that, that's why you would see prices rising. Kind of the knock-on effect of that, though, is if you do see Iran, their production, their exports being halted or grinding to a halt, that's when the Strait of Hormuz comes into play, right? Because that's in a tit for tat escalation.
There's no incentive not to go after that, right?
Exactly. That's where you could cause the most pain, and even then, it wouldn't have a long-lasting impact, right? Just because of the naval presence, etc. But if you were able to disrupt the Strait of Hormuz for a week, 2 weeks, something like that, that would have ramifications for higher prices. So that's kind of the scenarios, I think.
And as Nick Cumleben said a couple of episodes ago, right, you've got to assume all this is part of the planning, right? You've got to, yes, there'll be a short-term disruption, but you've got to assume that they are factoring in how they can protect ongoing supply if things were to escalate. Do you have any sense at the moment? Is that picture brightening, and it does seem to me sort of more hopeful that there is a deal to be done, and that Iran at least is convinced that the US is serious, and obviously Israel is very serious?
Yeah. Well, one thing we say about with Iran, they do like to have protracted negotiations, right? So this isn't something that is going to get easily resolved in a very short term way. So these talks are going to go on and on. But I think if you're going to have a situation where Trump is willing for Iran flows to continue, that may frustrate the Saudis or that, right? Because I suspect that's something that they want more than anything, is to be seeing Iran getting put in its place. But if Trump is after some type of nuclear accord, which he seems to want to be, that is going to have to include that crude continuing to flow. And so I think that is the kind of the base case expectation, or the more likely one at least.
Yeah, and ironically, we're just going to end up back at the previous deal, I imagine.
Right.
But okay, yeah, that seems to be the more, as you say. But it is a flashpoint, and I imagine one that lots of algorithms are tuned into any news on that front. All things being normal, in a typical normal, whatever that was, world where there was less flashpoints around the world and free trade was accepted norm and interest rates were low, this would probably be quite a boring year. That being said, it's now sort of ruled by tweet, lots of uncertainty over policies, over tariffs, over sanctions, over export controls, and then a significant geopolitical flashpoints when you've got ongoing, war in Europe. You've got obviously Israel, Gaza, Iran, that whole nexus and so forth. You've now got India and Pakistan starting to have a crack at each other, not to sound flippant. Last year was actually relatively low volatility. The results of all the major oil traders, as much as we can glean, were kind of down 20, 30%. This year started quite quiet, but there was it was a pretty horrendous March and April. Fantastic for some, but lots of volatility, lots of losses out there. Can you give us some context of how volatile the market has been this year versus last? Is that set to continue? What are you hearing and seeing in terms of opportunities and challenges for the commodity trading community?
Yeah, sure. So I guess the volatility has been created by the uncertainty surrounding tariffs in the Trump administration, right? So it's more like, in the grand scheme of things, it's not being the geopolitical backdrop from a perspective of the flows, right? So, Russia barrels continue to hit the market, Iran barrels continue to hit the market, Venezuelan will be redirected away from the US, but probably to China, and they will continue to flow. So for the most part. So really, you're not seeing too much changing on that side of things. It's really on the demand side of the picture where you're seeing that impact from all of this uncertainty, which is then going to ultimately impact that non-OPEC supply, particularly from a US perspective. But when we kind of look at the bigger picture for the oil market here, China remains such a key. And I know from the tariff side of things, there's a lot to be worked out there. But ultimately, China provided 650,000 barrels a day of demand growth last decade, and you just are not getting that from them anywhere near anymore, and you may not do ever again. So, as the Chinese economy continues to go through pain, we're seeing gasoline demand growth out of them basically peaking because of the adoption of electric vehicles, as well as the economic softness. From the diesel side of the picture for China, is also peaking out there because of the adoption of LNG fueled trucking. So demand growth out of China has shrunk. So when that piece used to make up so much of global demand growth, even if it's still accounting for 20%, something like that, that demand growth piece has shrunk to 800,000, whatever it may be, 600,000, and China is 150. So this is the concern going forward here. And with China, we continue to say, with our macroeconomists banging the table for years, you have to get household consumption higher in China. In the US, it accounts for like 70% of GDP. In China, is nearly half that. So you've got to stop building things, roads, buildings. You've got to give the population the money to spend to get household consumption up. So because of the structural issues in China here, we are not going to return to 1.2 million barrels a day of demand growth. And so the supply side has to adjust to this new paradigm of slowing demand growth. So that's really going to be the crux over the coming years here, how suppliers are able to get their piece that they need, and who's going to get pushed out of the market depending on prices.
Yeah, we had Tom Reed on from Argus talking China about 5 episodes ago, which was just sort of fascinating, right? Mm-hmm. And the long sweep of that. I mean, I didn't know that China had its own oil production, right? I mean, it's sort of fascinating and quite opaque sector, and obviously looking at those teapot refineries is a pretty good indication of how sophisticated the market is there, and how they're trying to manage this really challenging demand picture.
Yeah, and that's the thing when we talk about China, we think about China. Yeah, like you say, we're almost dismissive just because they are so big. Like, their production is like 4 million barrels a day, right? That puts them as one of the biggest producers in the world, and yet you just don't really think about that because they're importing 10.5, 11 million barrels a day on a waterborne perspective. And then again with the relationship with the teapots, the independent refiners and the state-owned refineries, and the tussle and change that is happening there, all of these pieces are massive, right? And having huge influences on the market is just, and that's why I bring up China, because China is the fact their demand growth is slowing so much is having a very large impact on the market.
But it's hard to tease apart, right? Because again, this kind of comes back to this really fundamental question of, it's always going to be some part economy, some part technological change. Yeah. But are we seeing in China, that sort of tipping point, that acceleration, which we certainly are? I think over 50% of cars sold there are EVs. Yeah. Are we going to see an energy transition, as we had Kingsmill Bond on last year, that surprises to the upside, right? Actually, it's going faster than we think. It's a technological change, not a fuel change, if you'd like, and we're seeing it happen. So there's a lot there that kind of that needs to be poured over to understand and figure out what it means for the entire energy economy as we have it today.
No, exactly. And then there's others kind of in its wake, right? So as China kind of moves aside from driving on demand growth, you still have a lot of Asia, Eastern Asia, that is kind of stepping up to a certain extent. And so,
yeah. But again, though, that would be, you would see a world where very cheap EVs out of China are going to certainly, create lots of mobility for the middle class in places like, Indonesia and India and so forth. But it is, again, is it going to be the combustion engine or not? Let's not get into it here. Just one other comment you mentioned, and then, like sort of get your thoughts for the rest of the year, or at least what people to watch out for. You mentioned the other sort of bullish picture is low inventories. Can you just dig into that a little bit and kind of why is that and what we should be looking at?
Yeah, sure. So just when you look at global onshore oil inventories, they are kind of close to the lowest level on our records. And part of that has been because of SPRs being drawn down, particularly in the US. We've had 250 million barrels taken out of that in recent years here, which are most likely not going to go back in. So we are actually in a new kind of paradigm. But to be fair, when you look at commercial oil inventories, they look fairly comfortable. It's just when you include that SPR piece that they look like they're that much lower. And so the inventory side of things from a crude perspective isn't as bad as it may seem at first blush. The challenge, I guess, even when you look at the US on the product side of things, yes, you do have low products, but that's something that the US market is getting used to. It's had that for a few years here. And so that really is a bit of a flawed argument for pinning your hopes of higher oil prices. Really, it's more the other stuff, the Iran coming out of the market, the demand side really getting geared up, which is going to influence prices more.
Yeah, and just on that low product inventories, is that just a function of having a far more sophisticated and efficient market that's been developed over the last 10 years that is more just in time than it is actually?
Yeah. It very much feels that way. Yeah, no, exactly where you can, the world continues to get more interconnected. You have, and actually one thing we haven't talked about is like just Middle East producers adding refining capacity, or we've got the Dangote refinery in Nigeria, all this refining capacity being added. Yes, you may see Kuwait exporting much less crude, but it's exporting a lot more products. And so you are seeing kind of tectonic shifts in the global market in terms of those flows. So they are becoming more just in time.
Yeah, we're seeing US refineries shut down as well, right?
Exactly. That's what I was just going to say. Yeah. At the same time as you're seeing this, not vilification, but this trend of refineries closing, you're seeing it first of all in Europe, right? Europe's the weakest link from that perspective. In that, it's not just it's the lack of investment, it's the lack of willingness to invest in this type of industry. But to your point, the next domino after that is going to be the US.
Yeah, and this is at the FT conference a lot, right? Like, again, in a global free trade economy, we're maximizing economies for what they are best placed to produce, right? And it makes sense to put the refinery right next to production, and then Europe can afford not to have refineries because you're able to buy it in cargo form as and when you need it, right? That whole picture, so that all makes fantastic economic sense. That suddenly becomes under threat when you've got disruptions of global trade through unilateral tariffs and all this piece, right? A sort of mercantilism return. But also actually when you look at it through a security lens. And that's in some way what the market the commodity sector in general starting to wrestle with, which is, yes, we don't actually need this refinery. It's losing a lot of money. But if we don't have the capacity to make steel or, create jet fuel in a more disrupted world, that's a real challenge for us. So that there's all that picture there as well. To a new lens, in other words, of security is coming into how you analyze these markets.
Absolutely, and that's why when you look at the likes of the Middle East, it's not just one of them, right? It's Oman with the Duqm refinery, it's Kuwait with Al Zour. You've seen expansion of Jazan in Saudi Arabia, UAE, Nigeria. You're seeing it across the board, and it's a very smart thing to be doing because, like you say, you do have those refineries next to the production there, but then they control they have all the chips, right? And so then it just gives them greater control over the market here.
Yeah. Okay, well, we could go on for ages. I've really enjoyed this.
Me too.
But I guess a couple of questions to finish up on, and I don't know whether you can answer these or whether it's fair to ask them. But I guess, firstly, as a betting man, kind of what do you think the general outlook is for the rest of the year? Is it actually, this, we're kind of in a range of this, or might be slowly declining? And then secondly, on volatility, do you think it's going to settle down, or are we in for a longer period of there's so much going on that actually it is going to be a volatile year?
Yeah. So not being dismissive of everything we last talked about over the last 50 minutes of that, but despite all the bearish talk, the market is still fairly constructive, at least in the short term here, from the perspective that refining margins are strong. And granted that has in part been to play with weakness in oil prices really coming off, but to be fair, refining margins look pretty good right now. You have, the run's going to be increasing in the coming months here. You've got backwardation clinging on in the oil market, in the crude pricing. And so things don't really look too bad right now. The concern comes as we get past the peak of summer demand here and we head into August, September, that these margins are going to be coming off because demand is coming off. But at the same time, you've got OPEC continuing to hit the market month after month with more barrels. You have another Guyanese crude stream. You have more FPSOs from Brazil coming online. The worry is that all of this kind of hits around the same time, late summer, as demand is dropping, or we're moving away from the peak. And that's when prices kind of come off. Now, people may be trying to get ahead of that. That's why we've seen so much recent volatility here. But going forward, it feels that a price, well, let me say this. We use that kind of $69 level on Brent as support over the last 3 years. You got down to it, you bounced. You got down to it, you bounced. Now we've broken through that. You've essentially got a ceiling there. So the high 60s is the ultimate ceiling for prices here. It feels more like a $60 price. Low 60s is the path forward here. The worry is to the downside should economic things add to all of the other things I just talked about late summer here. So
yeah,
that's a concern.
And then volatility? I mean, is it going to, in other words, if it bounces around that range, are we bouncing around plus 2 or 3% every week, or is it going to settle down?
I think we're going to have continued volatility just because of continued uncertainty, not just within the market, but from the tariff side of things and from the political and the geopolitical side. So we shouldn't expect things to settle down anytime soon.
Yeah. Well, it's only fair after graciously using so much of your time where can we find you, and where can we get access to what you publish and your thoughts? Because I'm sure everyone's found this fascinating. And how do we get hold of Matt Smith?
Well, not specifically me, but Kepler, we push out a lot of good information just on our blog. If you go to Kepler.com, you'll be able to find it there. But on social media, we'll be pushing things out on LinkedIn, on our Twitter account as well. So go and have a look there. We're very liberal in what we share. So please take advantage of that.
Yeah. Excellent. Well, Matt, it's been a real pleasure. Hopefully we can have you back on again in a year or so. I imagine if you're on any sooner, it's because we're doing an emergency pod over some terrible disaster somewhere. Gosh. But so let's hope not for that. But thanks very much for your time, and look forward to having you on again in the future.
Thank you very much, Paul. I appreciate it.
Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.